Greetings, Culture Warriors. It is I, Jeff Vieira, the author of Culture is Everything, and your host for this latest dispatch from the front. Bloomberg story for you today. This is by Gerald Porter Jr. and Nick Quirolo. Kraft Heinz plans $2 billion in cost cuts, buoying shares. Kraft Heinz Company is returning to its tried-and-true cost-cutting strategy as the packaged food giant looks to strengthen its long-term financial position. The company will target $2 billion in savings over the next 5 years by focusing on procurement, manufacturing, and logistics, according to a presentation released ahead of its Investor Day Tuesday. As part of what's calling a strategic transformation plan, Kraft is now targeting growth of 1% to 2% for organic net sales, which excludes items like acquisitions and currency effects. The ketchup maker is also expecting long-term adjusted earnings per share expansion in the 4% to 6% range. We are committed to returning Kraft Heinz to consistent growth on both the top and bottom lines, Chief Financial Officer Paulo Basilio said in a statement. The company also updated its third quarter outlook, with organic net sales growth expected in the mid-single digits due to stronger than expected business momentum. Kraft aims to reduce net leverage by the end of 2020. Last quarter, Kraft's net sales beat the highest analyst estimates as the company held on to customers who flocked to packaged food staples during COVID-19 lockdowns. 3/4 of new customers made repeat purchases. A renewed focus on cost-cutting reads like a return to normal operating procedure for Kraft Heinz, which was created in a 2015 merger orchestrated by Warren Buffett and 3G Capital. Traditionally, 3G's managers were more known for reducing expenses than nurturing brands, and after merging H.J. Heinz and Kraft Foods, the then CEO slashed nearly $2 billion in costs at the combined company. When the cutting slowed, the spotlight turned to the company's struggle to grow sales with a portfolio of food brands that was largely considered out of step with modern tastes. However, the pandemic reignited consumer interest in comfort staples like Oscar Mayer lunch meats and Kraft macaroni and cheese, giving it a boost during lockdowns. Kraft shares rose 2.4% to $32.63 at 9:46 a.m. in New York. Okay, so Kraft Heinz was in a little bit of trouble a couple of years ago. I should say a lot of trouble. There were fears that the company was going bankrupt. I happened to be working for a company at the time who was looking for some business from Kraft Heinz, really counting on it, and they had to cancel it because Kraft Heinz was in such dire financial straits. So then along comes the pandemic and restores the demand for the kinds of foods that Kraft produces. And they mentioned Kraft macaroni and cheese, they mentioned Heinz ketchup, things that are not exactly the organic, healthy foods that everybody and their brother was telling you had to eat before the pandemic. Of course, the pandemic hits, people are at home more, people are preparing food more, and what do their kids want who are out of school and at home? Well, they want things like ketchup, and they want things like Oscar Mayer lunch meats, and they want things like Kraft macaroni and cheese. So you can see the reason why the demand boost happened, and also why it helped the company out. That said, they need to be able to grow their brands more than they are doing. And this one-time blip associated with the pandemic may not be sustainable over the long haul. So the focus on cost cutting isn't going to go away. Now, is that a bad thing? No, it's not a bad thing. The fact is, you look at any one of those 10Ks for those companies, and you'll find that the relationship between $1 in revenue and $1 of cost is not 1-to-1. In fact, every dollar of cost that you cut is worth generally around $10 in revenue. It's that big a delta. So it's important for the company to focus on how efficiently it produces its products so that it gives more wiggle room for demand to be reduced, to lower prices in order to goose demand as needed, as customer taste change to free up money that could be used for building the brand through marketing, through sales, and other things. The fact of the matter is, it wouldn't hurt Kraft to have a little more innovation in its products, to freshen them up. Heinz, of course, is associated with the number 57 because at one point, Heinz had 57 distinct products in its portfolio before whittling down over time to pretty much condiments, ketchup and mustard, and perhaps vinegar. I think they also make beans still. But once upon a time, Heinz was a pretty far-flung food conglomerate. It would be a good idea, especially if you can get the production of a high mix of products to be more efficient. It would be a good idea to try and restore that, to go with smaller markets for each of the things that you offer, but to offer a wider array so that as tastes change, you don't get too caught up in it. For example, if there becomes a buzz, for some reason against tomato ketchup and in favor of something else, well then Heinz as a whole is going to really pay a big price for that because so much is invested in that particular product line. You want to have a little more diversity to even things out. And so I think there's two values that should be looked at here, which Kraft Heinz would be well advised to really focus on as they come out of the pandemic. Number one is make sure that you're looking at your efficiency. You can't afford, especially in the post-pandemic environment where social distancing is required, you cannot afford to eat your margins to the extent that you have been. So renew and focus on efficiency, probably a great idea. Productivity, etc. In a related area, I think you need to start looking at how you're doing risk management to reduce the risk to those different brands. The whole point of merging Heinz and Kraft Foods was to have a fairly wide array of offerings that were a little bit more recession-proof. That hasn't turned out to be the case. So you need to look into how you're managing your risk and to get ahead of that a little bit. Thirdly, probably coming out of all this mess over the last couple of years over there at Kraft Heinz, cash is king. So you need to really focus on cash flow up and down your supply chain and making sure that you're keeping everything well lubricated so you don't compound your problems. Now, the common denominator in all this, what would help Kraft Heinz to maximize cash flow, to improve efficiency, and to reduce risk? Well, the immediate thing that comes to mind is adopting a lean approach, similar to what they do in the Toyota production system. Why? Because becoming a leaner operation means that you reduce lead times and inventory levels throughout, which tends to reduce complexity, which definitely reduces risk. And if you're able to reduce those lead times, then what happens is you're able to respond to changes in market demand much more efficiently. This is where you'll get the most out of the investment you've made in logistics and in procurement. So were I deemed COO of Kraft Heinz, the immediate thing that I would be looking to do is start to take those steps to fix my culture so that it will be more conducive to adopting lean thinking. And how do you do that? Well, number one, you have to reduce the fear. I'm sure that people working at Kraft Heinz for the last few years have been terrified of losing their jobs. You have to reduce the fear inherent in that business now by committing that no one is going to lose their job for making the business better. Now, that seems at first blush to go against the cost-cutting aspect of what they're trying to do, but it really doesn't. What it says is we're going to unleash all brains, all sets of hands to helping us become more efficient, and we're going to fund our delta here to plan in our costs that way rather than get rid of people. you're going to lose some people anyway. Not all of them are going to like the new approach. Some of them are going to take opportunities elsewhere. Others are just going to, in the normal course of events, retire from the workplace, etc. So you're always going to have attrition, but that's a different thing. What you want to do is remove the notion that just collecting badges is the way to prosperity. You cannot cut your labor force to prosperity. What you can do, however, is make your individual workers much more productive than they are today, reducing the need to hire more. And that's the endeavor I would encourage Kraft Heinz to embark upon. We have a once-in-a-lifetime opportunity, really, to do this coming out of this pandemic because so much has changed. And smart leaders will take a good, hard look at it because the operations that they run could be 10 times better than they are today. And that would make a humongous difference going forth in the future. So that's how it looks at Kraft Heinz. Looking a little bit sunnier, buoyed by the pandemic response and the embrace of comfort food. But before that runway runs out, this company really needs to be preparing for takeoff. Thank you and have a great day.